Save $250,000 or more on IRA or 401k withdrawals. In this episode, we are going to address the question, how can I save tax on my withdrawals out of an IRA? This is an actual example. I changed the names. We're going to call them the Smiths and the Jones. But put on your seatbelt. This will blow you away just like it does CPAs and tax attorneys when I show them this example. My name's Doug Andrew, and if you've watched some of my other educational episodes, welcome back. But I'm going to share with you a very powerful story that is actually taught in my book, The L.A.S.E.R Fund, because I have 62 actual stories and examples of clients where we have saved them $250,000, $500,000, one couple $1.2 million of unnecessary tax on their IRAs or 401ks. Now, when I say unnecessary, it means they didn't have to pay the tax if they learned how to do this strategic rollout. So we're going to call these two couples the Jones and the Smiths. Now, as we talk about them, they're both 60 years old. And at age 60, since you're over age 59 and a half, you can access money out of your tax-deferred IRA or 401k without a 10% penalty. If you take money out of those accounts before age 59 and a half, the IRS will penalize you 10% on top of the tax. So many times people hit age 60 and they're still working, but they want to slow down. And so they go to their accountant and they say, well, we don't need the money out of our IRAs. What would you suggest? Oh, well, if you don't need it, leave it there. Keep deferring it until you're age 70 when you plan on retiring. Why would you want to take it out and pay tax when you don't need to? Sounds good on the surface, right? Let's look at the Jones who did that. The Jones, they're 60 years old. They have $250,000 in their IRAs or 401ks. So far, so good. They decide to leave it in there. Let's say they're earning 7.2% rate of return. Now, I like that number because I've actually averaged 7.23% in the worst decade since the Great Depression using my favorite vehicle and strategy. It's called affectionately the L.A.S.E.R Fund. I wrote a book about it. And the L.A.S.E.R Fund is the only vehicle in the Internal Revenue Code that allows you to accumulate, access, and transfer your money tax-free. I have earned 7.23% in the worst time. I've actually averaged way more than that because of other strategies I teach. But this couple, let's say that they are confident that their money in their IRAs will earn an average of 7.2. So let's use apples to apples here. At 7.2%, if you understand rule of 72, in 10 years from age 60 to age 70, their $250,000 will double to 500,000. Okay? Now, at age 70 and a half, it used to be you had to start withdrawing money or there would be a 50% penalty on what you should have withdrawn. That now is age 72. But let's say they're ready to start taking money out. But they only want to take out interest only, which is under the limit to not have a 50% penalty on an RMD. So if they're earning 7.2% on 500,000, that's 36,000 a year. They pull out 36,000. That's on the front of their tax return. That's portfolio income. You pay tax on earned income, portfolio, and passive income. Let's say between federal and state tax, they pay 33% in tax, which is very typical for many retirees. A third of 36,000 is going to have to go out the window in tax. It's what Uncle Sam planned on. Uncle Sam's been planning on this revenue. You pull out 36,000, you pay 12,000 in taxes, and you net 24,000 a year to buy gas, groceries, prescriptions, and golf green fees. The Jones follow the herd. This is what most people do. You want to see what the Smiths did to end up with double? Watch. I have been a tax minimization specialist for 47 years. This is what CPAs go, oh my heavens, I can't believe I have never been taught this. The Smiths, they come to me at age 60 and they ask for my advice and I go, so tell me your plans. Well, we would like to slow down a little bit and sell our home. We can sell our home and not pay a capital gain tax on it because we have a limit of $500,000 to do that. And so we want to get a little retirement home that's taken care of in a retirement community. It's going to cost $250,000. We want to get one down in southern Utah and have another little house. Now, depending upon the area of the country, they may now cost twice that. But this is a couple several years ago, and all relates no matter what the cost of retirement housing is. So stay with me. So they have the same $250,000 in their IRAs or 401ks as the Jones. In fact, they work at the same company. But what do they do different? I tell them, you know what? Your house is paid off. You've killed your tax deductions. Sell your house and take the new properties, the little retirement home here for $250,000 and the other one, and just pay 20% down and finance the rest. So they finance $500,000. So what's really happening is they sell their house and they keep $500,000 of the equity, and they only use the rest. They sell their house for $600,000 or $700,000. They only use what they have to pay down payments on their 2 retirement homes. So far, so good? What? They have a mortgage? They didn't want a mortgage in retirement? Is this good or bad? So they have a $500,000 mortgage. Now, at the time, mortgage rates were 7.2%. So at 7.2%, I told them to do an interest-only mortgage because this will keep it simple. 7.2% interest on a $500,000 mortgage balance between the 2 retirement homes is $36,000 a year. That's $3,000 a month. They have to pay interest. Where are they going to get the money to pay the mortgage payments? They withdraw $36,000 out of their $250,000. See, their $250,000 would have grown to $500,000 like the Jones, but while it's doing that, they're pulling out $36,000, subjecting it to tax to pay the interest on their mortgage. So it's a wash. They pull out $36,000. They have to report it on the top of their 1040, but then underneath that, they get to deduct the interest, and so it's a wash. What's happening here? They're withdrawing $36,000 a year out of their IRAs with no tax consequence. It's a wash. Let's go over the 10 years. They took out $36,000 out of their IRAs over 10 years. They withdrew $360,000 tax-free. What was the trade-off? What was that for? The $500,000 that they did not put into those retirement homes has been in their L.A.S.E.R fund, and it's been earning just 7.2%. Actually, history has shown it has done far better, but I'm wanting to use apples to apples. So their $500,000 in the L.A.S.E.R fund doubled to $1 million. They have $1 million. They have twice as much money as the Jones. But the Smiths have a mortgage. Yeah, $1 million in the L.A.S.E.R fund minus the $500,000 of mortgage balance. They have the same $500,000 as the Jones, but what's the diff? The Smiths' million is tax-free. They could take out half of that and pay off their mortgages. When they asked me, I said, I wouldn't do that. Why? Hello? You want to be your own banker. Watch. So if you need to stop, pause, rewind to understand this, do it. But here's where I'm going to connect the dots. What's the difference? The Smiths have $1 million accumulating tax-free in their L.A.S.E.R fund. The Jones have $500,000 in their IRAs. They have to pay tax on the rest of their life. Yeah, the Smiths have a mortgage of $500,000. $1 million minus $500,000 is the same $500,000 they have, but this one's tax-free. Why is it tax-free? It's because it is grandfathered in the Internal Revenue Code to be that way, and that's why I call it the L.A.S.E.R fund, liquid assets safely earning tax-free rates of return. So the Smiths have $1 million, and they want to start living off of their money. At 7.2%, that's $72,000 a year. They take out $72,000 a year. It doesn't deplete the principal there of $1 million. That's tax-free. It's not deemed earned passive or portfolio income. The IRS knows they're receiving it, but they know it's tax-free. It's not even worth auditing because it's always been tax-free. Out of the $72,000, I told them to keep their mortgage. Now, the $36,000 of mortgage interest is still deductible. So in a 33% bracket, they write off that interest the rest of their life. $36,000 is really only costing them a net of $24,000 a year because they're saving $12,000 in tax. So the dollars to dollars, apples to apples comparison shows this is their net mortgage payment. They take out $72,000. They have to pay $24,000, their portion of the mortgage payment. The IRS covers the rest. Watch. They have $48,000 left over of annual income. How much better is $48,000 than $24,000? It's double. We do this all the time. I have helped thousands of people double their net spendable retirement income and get their money out of their IRAs or 401ks with no tax consequence by resurrecting deductions. They paid off their house. We didn't pay cash for the 2 new houses. We became our own banker, resurrected deductions, and we got our money out of the IRA or 401k tax-free. If this is making sense to you, I want you to watch these episodes and see other examples of how we've been able to do this for all kinds of people, no matter how much money they had trapped in their yet to be taxed IRAs or 401ks.